Good evening, ladies and gentlemen. My name is Devadas Krishnadas, and I'm the founder and CEO of the Future Moves Group, or FMG. I'm also the author of the best-selling book, Confronting COVID-19, which is available on Amazon SG and in all good bookstores in Singapore. This evening, I'll be sharing perspectives and insights on the Budget 2021, which Deputy Prime Minister Heng Keat has just delivered in Parliament today. I will not be repeating the details of the budget, as these are now accessible on the website of the Ministry of Finance. Rather, I will take some 30 minutes to focus on select key issues and give you FMG's take on the implications as well as expectations for the rest of 2021 and beyond. Let me first begin by introducing the Future Moves Group, or FMG. FMG is a Singapore-owned and based consultancy with nearly a decade of experience, primarily focused on consulting on public policy and corporate strategy. We have undertaken projects in developing and developed countries across 4 continents. Details on how to contact us will be available at the close of this video. Let me now turn to the substance of the budget. First, to put things into perspective, while this is Budget 2021, it is also possible to see it as a 6th COVID response budget. This is both because we are still in the COVID situation and also because of the considerable continuity with the 5 budgets that were passed in 2020. It is an expansionary budget whose objectives are similar to the preceding budgets in 2020, which are primarily to be counter-cyclical to support the economy, focus on supporting workers, attempting to save jobs, and helping companies to adapt and survive. This budget is more modest than the first 3 budgets of 2020, but there are no surprises here for 3 reasons. First, 2020 was the first year of COVID, and there was a need for rapid response on a large scale, which was an imperative that the government met with a clarity. Second, the budget continues to maintain the momentum of the committed expenditures of the 5 2020 budgets, whose fiscal impulse did not end with 2020, but continued to flow and have impact in 2021. Third, 2020 was an election year, and the PEP, the government, the party in power, was clearly being as populist as possible to succeed politically. Ironically, it had its worst showing in electoral history, despite the historical levels of counter-cyclical expenditure. Let me touch on the topic of mistargeting. The budget continues to focus on propping up the most highly impacted sectors, such as tourism and hospitality and aviation. These sectors are essentially dead in the water and will remain so for at least another 2 to 3 years. Only organic market forces from a genuine recovery of external demand will revive these sectors. Hence, our view is that continued large-scale support is just so much throwing good money after bad, as it will not and cannot resuscitate these sectors on its own. The budget also continues to have a strong focus on saving jobs with wage support and other measures being continued. We believe that this creates significant moral hazard, defers much-needed restructuring, and insulate workers from the reality of having to adapt. Hence, we classify these measures as being populist rather than pragmatic, and a departure from the tough love stance of the 2 and 3G governments from the 1980s through to the early 2000s. Deputy Prime Minister Heng has also announced a package amounting to $900 million to support households. In our view, the majority of the ingredients of this package are populist and deadweight. While we agree that the social compact is critical to Singapore's viability, it is not something which can be bought at any price, but must be ensured by genuine community bonds and earned through mutual trust between government and the people. We are heartened, though, that there is an improved sense of proportion in this budget compared to the budgets in 2020. The government has claimed that its $100 billion in interventions in 2020 reduced the contraction of the economy in that year from 12.4% to 5.8%. We have no reason to doubt this claim. However, we note that the $100 billion was hastily allocated on a broad-based basis without the benefit of rigorous analysis that usually precedes the introduction of new expenditures. We are thus heartened that Budget 2021 is taking a more measured, targeted, and calibrated approach to expenditures. Nevertheless, we hold the view that the cumulative impact of the 6 budgets, 5 in 2020 and Budget 2021, has created moral hazard in the economy and for households. And when it comes to highly impacted sectors, a pushing on the string effect. We strongly advocate shifting the focus from highly impacted to supporting high impact sectors. These are sectors which are knowledge-based, highly productive, amenable to internationalization, export-orientated, and with strong, even if nascent, growth potential. These are the sectors which will not only see Singapore through the crisis, but pull it up when there is a structural recovery. In addition, these sectors in aggregate represent the transformation of the economic structure that the government has long sought. So we support without reservation the government's measures in the budget which are focused on high impact sectors. But to enable the full transformation to be a success, creative destruction must be allowed to work its effects. We cannot let a crisis go to waste. Creative destruction is where weaker firms, those less well-led, those who have not adapted to changing conditions, or whose customer base is eroding inexorably, are allowed to fail such that their scarce factor inputs of land, labor, energy, and capital can be reallocated, albeit with time and with friction, to better performing firms and sectors. In other words, while well-intentioned, the government should not use grants and subsidies to try to save every job and every firm. It points to the increase in grants to companies from 1.5 billion in 2019 to 27.4 billion in 2020. This abrupt and many multifold increase, both through existing and new expenditure channels, saved a lot of firms. But many firms, MNCs in particular, did not need saving. And many firms that were saved did not deserve saving. Thus, there was considerable deadweight and misallocation. It also exacerbated the grantpreneur effect, which is a perverse outcome where firms thrive almost exclusively on government grants rather than through competition, innovation, or productivity improvements. We are concerned about the growing challenge of the numbers of structurally unemployed, underemployed, and those who have fallen out of the workforce entirely. We note that the budget did not address these categories at all. As reported by the Ministry of Manpower, as of 2020, 4.4% of residents were unemployed, and among employed residents, 4.1% were underemployed. These figures were not a feature of the budget, but they should have been. And we would like to have seen efforts to outreach to these categories of workers and find ways to pull them back into the workforce before it's too late. Let me turn to economic prospects. We agree with the Deputy Prime Minister that Singapore's economy is recovering. However, the projected growth in percentage terms is misleading as it is off a very low base in 2020. In absolute dollarized terms, the recovery will still be anemic, and there are greater downside risks than upside potential. First, China is the only large advanced economy that is growing. Singapore is reputedly the world's largest investor in China. So the recovering in China is a positive impact on Singapore companies. However, much of the economic and financial trade in Singapore with China is entrepot, which means that it is only when markets of final demand for China's goods and services recover that the recovery will be strengthened and be more assured. But the prospect for that looks far from certain in the near term. China alone doing better does not mark the end of Singapore's economic woes, but it may mark the beginning of the end. Second, Singapore cannot afford to remain closed off to international travel and trade for much longer. We will have to take the calculated risk to open up. Doing so will make it vulnerable to the potential second wave of infections and by more virulent variants. This may lead to a second circuit breaker which will nosedive the economy and do significant structural damage. This is a possibility that cannot be excluded. Third, we are concerned that in the early phases of the recovery, which may last more than 2 years, the recovery may be a jobless recovery. This may be for two reasons. First, that firms may remain hesitant to take on employment risks till the recovery is firm. And second, because many firms would have adopted digitalization and substituted for labor during the crisis. Hence, our expectations of the economic prospects for 2021 are more sanguine than both the budget and most private sector economists. Our baseline scenario is for -3 to a +3% range in real terms, depending on a number of variables, including the slow rate of the vaccine rollout in Singapore, for which the budget does not provide any explanation. On the upside, we expect productivity growth to be positive in 2021 and 2022, in part to a reduced labor force relative to output, and due to the adoption of technology, these factors having an interlinked relationship. We applaud the Deputy Prime Minister for appreciating the shifts under COVID are structural and permanent, but largely still uncertain. His allocation of $24 billion over the coming 3 years to support companies is welcome, but the devil is in the details and in the efficacy of implementation. We also recognize the value of initiatives to protect intellectual property and intangible assets. Likewise, tapping on ASEAN as an hinterland is a wise and worthwhile pursuit. However, given the reality of cross-border complexities and cultural divides, we have managed expectations of how much and how well collaborations will unfold. We also support the government's emphasis on worker transformation. We are convinced that we need to see a worker 4.0 in tandem with Industry 4.0. Thus, the government's intended investments in human capital are well warranted. We note that there was no mention of returning the monies drawn from past reserves, some $50 billion, back to the past reserves. This is a break with the precedent set in 2011, when $4.2 billion, which were drawn from past reserves, were replaced with the reserves after they had been drawn down in 2009 and 2010. We welcome Deputy Prime Minister Heng's reassurance that fiscal prudence is still a principle of governance in Singapore. However, we regret that he has announced a further draw on past reserves, and we are deeply concerned that he has taken an anticipatory approach to continued future draws on past reserves when we feel we should be tightening our belts. We see this pattern as worrisome, and we do not agree that the current additional draw is entirely warranted. Concerned with the innovation of borrowing to fund long-term infrastructure projects. While we acknowledge the reasoning, we see this as another departure from the fiscal principles which undergirded Singapore's fiscal resilience. Fiscal prudence is not what one says, it is what one does fiscally. In this instance, the government may be saying one thing but doing another. Let me now turn to the forward fiscal view. Looking ahead, we place a 50% probability that there will be another off-cycle budget in 2021 to show up the economy, as government revenues are accrued as it gets further into its first year of the term of government. We expect an uplift in contribution from stamp duties from a vibrant property sector and from GST through the consumption multiplier primed by government expenditures. However, we concur with the Deputy Prime Minister that we are going to be running a major deficit once again. He has anticipated that this will be $11 billion. Coincidentally, this is the same equivalent sum of the $11 billion of a COVID resilience package that he has introduced in this budget, for which the additional draw of past reserves is necessitated. We further expect that going forward from 2020, the government will fully tap the potential of the Net Investment Returns Contribution, or NIRC. We also take the view that it is holding in reserve the option of amending the Constitution to raise the ratio of the long-term returns which can be tapped under the NIRC framework. We know that this has been done once before in 2008, which allowed up to 50% of net investment returns, or NIR, on net assets invested by GIC, MES, and Temasek, and up to 50% of net investment income from past reserves from the remaining assets. The annual NIRC amount is published in each year's government's budget. Prior to fiscal year 2009, there was only the NNI component. The NIR component was introduced in FY 2009 with the implementation of the NRI framework. This completes the NIRC framework, which allows government to spend up to 50% of expected long-term real returns, including capital gains, from net assets invested by our investment entities. Amending the Constitution again to raise this ratio for extraction of long-term real returns for current expenditures, perhaps up to 60 or 70%, is not improbable and is an alternative to the repeated recourse to directly tapping past reserves over and over again. Deputy Prime Minister Heng spoke about the necessity of raising GST. He has reiterated that the government will do so in this term of government, from 7% to 9%. We anticipate that this raising will take place 1 year before the next general election, in other words, in 2024. It bears noting that a raise from 7% to 9% is not actually a raise of 2%, but a raise of 28.5% percentage upon percentage. While the government has explained again in this budget that its continued practice of redistribution to cushion the impact on the lower income makes its case that one must look at the system of tax and benefits as a whole, we hold the view that such a move of raising GST is still regressive. Notably, it places a greater strain on the middle class, which pays the taxes but does not benefit from GST vouchers. We are disappointed that the budget was blind to the growing income and wealth inequality, although it was mentioned in passing. The government measures the former but not the latter. The Gini coefficient for Singapore was 0.45 in 2020 before government taxes and transfers. This is very high. Singapore has become the go-to haven for the global rich. We question the logic of promoting this trend and ask for evidence of positive and significant knock-on economic and social effects. We are concerned that encouraging wealth inequality is equivalent to storing up a storm that will be political, economic, and social. The blind chase for wealth and the wealthy is unhealthy for social cohesion and the sense of national identity. We have seen evidence in other countries that COVID has worsened income and wealth inequality. And despite explanations to the contrary by the government, we believe this will be the case in Singapore as well over the longer term. This will require even more intensive redistribution to dampen inequality effects, which will place more pressure on the fiscal balance and add a further squeeze to the middle class, who bear the costs, but we expect in turn that they will extract the political costs from the PAP in 2025. Let me now sum up. Budget 2021 should not be seen in isolation, but as part of a stream of fiscal supply originating from 2020. It is notable for both what it addresses as well as what it does not. Longer term, the weak economic prospects for the foreseeable future due to macro factors may face further downward pressure on total fertility rates, which are already very low at 1.14. In addition to the inequality and the middle class squeeze that I've spoken about, it ignores the fact that the much vaunted future economy ITMs or industry transformation maps are now so much fish wrapped, and we should not be continuing on the autopilot of assuming that they are still valid. There is a need to go back to basics and focus on hard choices and fundamental rethinking of Singapore's economic and financial direction. Budget 2021 does not do either, and so in our view is a more tactical and an insufficiently strategic budget, and it to an extent indulges in wishful thinking and unrealistic expectations of and for transformation. Nevertheless, we applaud the government for trying to improve the life of Singaporeans and the economic future of Singapore. However, we conclude by noting the emphasis on the criticality of sustainable development and mitigating climate change is welcome. This does reflect a long-range foresight and a willingness to make sticky investments over the longer term. We applaud the government's commitment to a zero emissions policy, and we feel that in the context of ASEAN, this allows Singapore to act as a beacon for other countries to emulate. We close by thanking DPM Heng for his efforts with Budget 2021. As always, we wish a success to the government, as his success is success for Singapore and Singaporeans. Thank you very much for listening to me. We look forward to your getting in touch with clarifications and questions, as well as business inquiries. My name is Devadas Krishnadas, and with this I conclude this episode covering the Budget 2021. Thank you.